Good morning and welcome to the VIANET Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Chairman and CEO James Dixon. Good morning to you.
Yeah, good morning and thank you for joining us today. I've got Mark Foster, CFO, with me here, and Sarah Bentham, our Finance Director, to answer any questions that Mark and I might struggle with. We'll move straight into the results. We think they're a strong set of results despite the economic backdrop. Very good momentum in unattended retail and real progress in new verticals, as demonstrated by the wins in the forecourt sector with Romtech and Wilcomatic. And of course, we had the BMI acquisition, the Beverage Metrics acquisition in May 2023, and the integration, and that's going extremely well. And the hospitality division, now we think it's turned a corner and it's looking really positive going forward. The numbers themselves were ahead in all the key metrics, so we're in a good place for it to fuel our ambitious growth plans. The bottom line is that for the past couple of years, we've had a real focus on top line growth, and we're starting to see that come through now. For those of you who are less familiar with VIANET or new to VIANET, I'll do a quick summary of what we do. We basically help customers transform their business performance. In essence, letting them do more with less. We install hardware that allows us to harvest data, and that's processed through our software platforms to create dashboards, alerts, and traffic light systems to help people run more efficient businesses. We have two divisions. Unattended retail division, which by the end of June, early July, will be closer to 40,000 devices in vending and unattended retail machines out in the marketplace. And then the hospitality division, where we're in the best part of 10,000 pubs, bars, and restaurants. In essence, we sell hardware, install hardware, and we get paid for installing that hardware. So we have CapEx sales or rental sales. And then we have weekly and monthly subscriptions, and that's for service packs, licenses, and data processing. All long-term contracts with 3 to 5 year terms. I think one of the sort of important things to really highlight is that we have a high degree of recurring income. And unlike a lot of businesses, it's less transactional income, it's subscription income. So there's very strong visibility on the levels of recurring income that we have. If we turn to the financial highlights, without stealing any of Mark's thunder, I'll just touch on some of the key areas here. Strong financial results, ahead of expectations on the key metrics. And that's with a background of the mobile network operators 3G switch off. That created a bit of a distraction for customers as customers try to determine what they're going to do to address the 3G switch off. So that impacted the first 3 quarters of the year, but there was a strong rebound in the fourth quarter of the year, and that's came through in the results, and that's looking positive into full year 25 as well. Hospitality turnaround, we're really pleased with the performance there, and we're set to see that grow further. Bottom line is that absolute focus on footprint expansion in new and existing customers to drive our top line, and basically with our strong cash generation, it flows through to our earnings. Quickly touch on revenues up 8%, recurring revenue 85% of turnover, down from 89% last year, really driven by the the high proportion of hardware sales in the fourth quarter in smart machines. And of course, looking here, our cash generation is strong. Net debt is reduced substantially, and the EPS has risen strongly. And that's allowed us to propose a 50% increase in the final dividend up to 75.75p per share. Moving on to smart machines. Basically, we tick a lot of boxes in terms of we have excellent hardware, great customer support, award-winning customer support, cutting-edge management software platform, the most competitive transaction rates in the marketplace through our relationship with SureSight, and we've got highly competitive pricing because we see an opportunity to establish a much larger footprint and drive recurring income from that footprint. We had a winning 3G switch-off strategy, which was all based about retaining our existing customers and gaining new customers. We were first out of the blocks with a comprehensive guide to the government's shutdown of 3G, the mobile network operators' response to that, what that meant for industry, and what that meant to unattended retail in particular, and the solutions that we proposed for our customers. And having got out of the blocks early, we built a lot of trust with customers, and we've managed to establish longer-term contracts with our existing customers to upgrade the 3G to 4G and give them a level of pricing that encourages them to go to a statewide connectivity, which will again drive our recurring income. Importantly, too, we made an entry into buying groups, some substantial wins in there, an area that we hadn't particularly been strong on historically, but we've come through strong, and that's really driving the growth as well. I'll leave everything else to Mark and move on to the forecourt sector. There's been 24 months of really hard groundwork, working with SureSight and utilizing key relationships that some of our personnel have within the forecourt sector, and taking advantage of the 3G switch-off, which has been impacting unattended retail in the forecourt sector, and creating a degree of dissatisfaction with the operators, with our competition, and that's opened some doors for us. As you can see here, there's a substantial UK self-serve market covering car washes, jet washes, vacuums, and air towers. In general, these are higher ticket vends. Take some rollover car washes, you can be rolling up towards £10 a car wash, and that's pretty substantial compared with average vends across the wider unattended retail market. That means you've got to have a high degree of reliability. You've got to have hardware that is robust and functional, and you've got to have a support network, because if a payment system is down and the car wash in a supermarket car park, then that's substantial revenues they're going to be losing. So reliability is key, and we tick those boxes. SureSight are our partner of choice, and they've historically had a strong presence within the forecourt sector, where they've done a lot of payment processing on fuel transactions. And working with us, they saw an opportunity to get involved in unattended retail transactions on forecourts across the self-serve market. And to date, the good news for us is that SureSight actually act as an arm of our sales team. They've got over 200 independent customers that they do fuel transactions with, and those customers all have some form of air tower vac or jet wash or car wash, and they can give us access to that. So we work with them, and to date, ShareSite have taken in excess of 600 devices to install in that independent sector. In the last 6 months or so, we've announced Rontec and more recently Wilcomatic, best part of 2,000 devices going onto machines with those operators. And we've got further field trials underway across a number of players. There's also a linked opportunity. The bottom line is that working with these operators in the UK sector has introduced us to some of the car wash machine manufacturers and operators in Europe. So we're in discussions at this moment in time about ensuring our hardware is compliant with European operations. So it's a case of nothing built into our numbers at this stage, but it's a case of watch this space. And then we look at increasingly there's going to be unmanned forecourts that are going to create vending opportunities. You look at EV charging, where someone pulls into an EV charging station and then we have to wait 20, 30 minutes to charge their vehicle. Now that's an opportunity for an unmanned EV charging to actually have something similar to when you're waiting for your MOT to be completed, where you can actually go and actually utilize a vending operation to make for a better experience. And that's going to be on the increase. So a significant UK and European opportunity that we're working hard on. Moving on to hospitality. Our core leased and tenanted operations are robust, and they performed particularly well during the cost of living crisis. Why is that? That's because you've got an entrepreneur who's personally invested in an operation and will work all the hours that are needed to make that operation successful. Managed operators don't quite have that same flexibility where everyone is salaried or on 0 hours. We have a pretty substantial and solid install base of over 9,600 pubs. That's down 194 pubs in the year, which is the smallest decline in the pub sector that we've had for probably 10, 12 or more years. So I think the vast majority of the tail of the pub estates has been moved on now, and we think we're in a pretty decent position there, and where we can start to actually look at turning the corner and actually growing it. I think if we look at what Beverage Metrics brings to the party for us, through COVID, we re-engineered our draft beer flow monitoring product to reduce the hardware costs, improve the ease of installation, and reduce our ongoing costs with it, and also to make it more intuitive, user-friendly for our customers and their operators. And that's been paying dividends. And now that that's been integrated with Beverage Metrics inventory platform, we have basically an all-encompassing solution for customers that is sort of driving some real interest and engagement, which is positive for us. So revenues are up, operating profits up, recurring income is up, and with the BMI acquisition and integration and launch in the second half of last year, we're in really good shape. The other positive thing as well is that the inventory solution can be sold standalone, so it's not dependent on a pub or a bar, or hotel having strong draft beer sales. So it also does not require us to go to site to actually install and implement. It can be all done remotely from our offices. And the other positive with the BMI as well is that the point of sale shift variance analysis, where we're ensuring that every pint that's poured is going through the till, that in itself provides a return on investment before we start to look at any of the other productivity gains or reduction in waste. And effectively, if we can have one additional pint a day going through the till, that pays for the system. Turning over to the prospects for UK hospitality. Well, the key drivers work in our favour. Costs have gone up, whether that's wages, utilities, raw materials. Pub operators are under pressure from a cost perspective. And they're under a bit pressure on consumer pricing elasticity, because as pricing has gone up over recent years, it's almost at a breaking point where there's a limit to how much further they can increase their pricing to the consumer. With those limited options, that means they need to do more with less. So we can help them, ensure that they're actually getting the revenue going through the tills, that every pour goes through the till, and helping them do more with less, helping them increase their productivity. If you get a pint right first time, that means that it's in the consumer's hands right away, which means the bartender can move on to the next consumer, and that consumer has started drinking, which means that you increase your throughput as well. So you increase your throughputs and increase your productivity by actually getting it right first time. And that goes for line cleaning, it goes for lifting keg and waste as well. We've got substantial UK business. Now, those 9,600 pubs, we've been in operation over 20 years. We're part of the landscape with little or no competition in the UK. So a really strong base to, layer on Beverage Metrics products on our existing customer base and grow that, and also move into the wider pub market. I've touched on what Beverage Metrics brings to the party. Our products and solutions are increasingly relevant to the wider pub and hospitality market. Looking at the pub market in isolation, it's almost 4 times larger than our existing business. So that creates an excellent opportunity for us to grow utilising the Beverage Metrics solutions. Bottom left-hand box there, opportunities in current customers. There's probably still in the region of 1,000 sites, 1,000 pubs and bars to go at in our existing customers. And we're starting to see increased engagement and footprint expansion because customers are wanting to maximize the efficiencies. It's not just about securing your delivery, your supply chain. It's also about maximizing efficiency in those pubs and making them more successful. So that's playing into our hands. Beyond the leased and tenanted, we're making some inroads in managed. And one example is a pilot in a significant managed player in 30. It was paid for pilot in 30 pubs, and the results have been very encouraging, and we expect to sort of move that forward in due course. Another pilot is a 250 tap stadium trial in the Oval. And of course, you can imagine that if you've got a cricket match or an event on there, it's a one-time hit. So they want the information real time. They don't want to wait until next day like most other customers. They want it real time, because if there's an issue on site, they want to be able to act on it immediately, so it doesn't detract from the day's takings. And moving on to the acquisition of Beverage Metrics itself. Well, I guess we bought them because they have a perpetual inventory management platform that we're in the process of integrating with. And we have now, post-acquisition, we've fully integrated our draft beer management solution with the Beverage Metrics. So it's all-encompassing. The only thing that we lack at this moment in time is a wines and spirits monitoring solution, and that's something that is on our agenda. Bottom line is it's a configurable dashboard. It's intuitive, user-friendly, allows the operator to drill down, and ensures that they're not overloaded with data, so they get information paralysis. And as I touched on, the bottom line is that the shift loss report pretty much drives payment for the system. One additional pint a day going through the system pays for the system, and everything else is a return on investment. And then if we can help operators improve quality where they're getting a perfect pint first time, every time, that means they're improving the productivity and also reducing the waste. And in the current environment, that's helpful. There's been a high degree of engagement both in the UK and the USA because we're bringing something to operators and pub owners that we've not had before, and that makes a real difference. I'll turn over the page to cover our USA partnership and the opportunities that are arising in the USA. Firstly, very briefly, I'll touch on the US addressable market. There's over 380,000 on-premise units across 4 key segments in the US that are all sort of relevant for us. And if you take some of the customers that we're dealing with at this moment in time, either in discussion on rollout or with pilots in place, Chili's have got over 1,200 sites, Outback over 700 owned sites, Applebee's 1,600, and Darden 1,800. And then you take Marriott in hotels with 1,300. So what we have here, it's a significant market. So the questions are, how do we access it? How do we serve that market? And that's where our partnership sort of comes into play with fintech, which I'll touch on shortly. So in terms of our progress in the United States, our proposition is quite simple. We give a return on investment in 3 to 6 months. And as I said, that shift point of sale loss report pays for it and gives a return on investment before you start to look at productivity and quality. It's intuitive. An operator only needs to look at our dashboard a minute every morning, and that allows him to figure out, A, traffic light system will say green, ignore, carry on, red, go ahead, you've got to act on this today. And the enterprise structures within our customers want to actually know that the action is being taken on those reds, and we help them do that. Margaritaville are a long-term beverage metrics customer, and we've now, in the past month, we've become part of the franchise technology stack as a first. Margaritaville have also had until the turn of the year, they had an exclusive franchise agreement where any new franchise site went to one operator in particular. That has now been freed up, and they've got aggressive plans to grow their franchises across the US, and that creates a wider opportunity for us. Chili's, we've got a 20-site footprint in Chili's, and they're in the process of upgrading all 20 of what was iDraft to our new beverage metrics platform, and that's really positive. There's another 1,200 to go at, so we're really pleased about what's happening there. Applebee's franchisee, the franchisee themselves have 100 sites in the northeast of the United States. Applebee's in general, over 1,500. And the positive thing for us is that the pilot ROI, we're given our return on investment inside 3 months. So really positive, and we're in negotiations at this moment in time. Outback pilot, pre-COVID, we did a 10-site pilot with Outback, and that delivered great results. And then COVID hit, and basically what we're doing now is we're going back in 10 new sites with the beverage metrics platform to validate the results they got pre-COVID. So in reasonable shape. Bottom line is, only takes 150 draft beer sites and over 100 3D fast scan inventory sites to get us pretty close to break even, and we're on the way to doing that. Moving on to fintech. Now, who are fintech? Well, fintech was born of the three-tier system in the UK, where the brand owner, the brewer, the spirits manufacturer is separated from the retailer by distributors. There is a clear separation. Every state, and even within some states, different counties will have different rules and regulations that need to be followed. Fintech, for over 30 years, have been providing alcohol invoice payment, payment collection, and payment reconciliation to the US alcohol retail market. As you can see from these bullets, they are a substantial player. 40% of all retail and hospitality establishments with alcohol licenses deal with them in some way, shape, or form. And they have over 240,000 retail customers on their system and 5,000 distributors and suppliers. So a substantial business. That kind of gives us unique access to decision makers in chains and to independents, because it'd be very difficult for VIANET to address the independent sector in the US, but fintech have access to the independent sector who deal directly with them, and that unique access was amplified at the National Restaurant Association show in Chicago on the 18th to 22nd of May, when fintech shared a stand when we shared fintech's stand at the show. You might ask why are fintech happy to partner with VIANET? Well, VIANET are the operational link to the retailer for a full cycle ecosystem for order, invoice, delivery receipts. If we look at that, we take the tail. VIANET and Beverage Metrics have the ongoing perpetual inventory that allows us to create the automated, suggested order, which is then submitted to fintech, and then fintech transmits that order to the various suppliers that might satisfy that order, and then that order ships, and we get from fintech what that order consists of, what substitutions have been, what items are missing, and then we can automate the receipt of that. So effectively what we're doing is reducing the labor involved in the whole process for the retailer, which improves the productivity across ordering, receiving deliveries, invoicing, and stock and inventory management. So it's a real sort of win-win. And of course, by doing this, it provides a source of competitive advantage for fintech in the face of anyone who might want to try and get in on their business. I'll move on to Mark now with the financials.
Morning, everyone. Hope you're well. A good set of financial results, progressively ahead of last year and the H1 2024 market expectations. Turnover was up 7.5% year on year. The gross margin held strong at near 69% from the incremental recurring revenue growth and a lower cost base. Recurring revenue itself was resilient at 85% compared to last year's 89%, and as Jim alluded to, it's the sales mix around hardware that impacts that dynamic. All that resulted in an improved EBITDA operating profit to 3.47 million, up nearly 12% year on year. The pre-exceptional EBITDA was up at over 4 million, nearly 11% growth year on year, and the net PBT was up 73% to 784 grand. And it's important to note that that is net of towards £500,000 worth of post-acquisition BMI, people and license costs. So a very, very good result, and that all played out into an improved EPS number you see at the bottom. We move on to the divisional stuff. Smart zones, including the US, turnover was up 5.5%. There was 260 new systems, as Jim's touched on. Recurring revenue was still very good at 94%, 8.1 million, compared to last year's 7.76 million, 95%. So good incremental growth. There were 3 new contracts, 8 re-signed contracts, all 3 to 5 year duration. The rate of pub disposals declined quite markedly in the year. The net reduction was 194 sites compared to last year's 344. Or gross, it was 454 compared to the previous year's 803. So a pub estate now of just shy of 9,640 compared to 9,758 last year. So a combination of the incremental recurring revenue growth and the unit sales, the reduced cost base, that led to a 0.6 million improvement in gross margin, nearly 10% year on year. And that played out into improved operating profit of 3.94 million, nearly 4% growth. Again, noting that's net of the post-acquisition cost of BMI. So it would have been that much more on a like-for-like basis. So very happy with that. In smart machines, obviously Jim touched on the 3G lag from the network switch off and then the move to 4G upgrades. There was a lag in H1, but turnover picked up in Q4 of H2. So we saw an overall 0.6 million growth in turnover, nearly 10% year on year. There were 73 new contracts, all 3 to 5 year duration, but predominantly 5 years. There was 8,900 new units compared to last year's 6,554, 35% growth. And all that means is we've got a growing estate. Gross margin was up 470 grand, 15%. We've got a healthy recurring revenue of 74%. And an operating profit growth by 450 grand, 22% growth year on year. So that's all good and only set to continue with the plans that we have. From a cash perspective, the business continues to be a strong cash generator, and this year was no exception, and probably more a normal year compared to the last couple of years coming out of pandemic and world supply problems. Operating cash generation pre-working capital and share-based payments was 3.83 million. That was up 10.8% on a like-for-like basis compared to last year's 3.46 million pre the tax rebate we accrued for in last year's cash generation number. Pre-share-based payments, this is 102% of EBITDA, demonstrating the strong cash to profit conversion or profit to cash conversion. There was a working capital draw of 259 grand. It's very much more normalised. That's the sort of level we'd expect to see either side of zero, mainly from increased trade debtors. And then we got the tax rebate of over 900 grand in May 23. So that helped us deliver a post-working capital tax generation position of 4.492 million, a big step forward compared to the position from last year. Those funds were invested in R&D development costs, intangible assets, overall of 1.7 million. But on a like-for-like basis, ignoring the impact of BMI in the year, it was 1.4 million, which was a 300 grand reduction on a like-for-like basis year on year. We refinanced the bank facilities, which I'll come on to when we get to the balance sheet. So overall, we had a 2.92 million inflow for the year, which is very healthy compared to the 1.37 million outflow last year. A good step forward and something that we can build on. From a balance sheet perspective, the balance sheet remains strong. It's been enhanced by the HSBC bank refinancing and the flexibility that affords. As we touched on in working capital, trade debts have slightly increased because of the increased turnover in the year. Stock levels post the 3G lag are now starting to unwind, which we said they would in due course. We have cash in the bank of 1.8 million compared to 69 grand of the year before. We don't have an overdraft now, but obviously we have refinanced the debt position. So across an RCF, a loan and a mortgage, we have interest rates of 2.42 to 2.62% above base. Very healthy competitive levels of borrowing, which is considerably lower than the previous bank we were with by over 1%. And all that contributed to net debt being much reduced to 1.52 million at the year end compared to 3.37 million the year before. So a significant reduction that helps support our growth plans.
Thank you, Mark. just summarize where we are. We're in a pretty exciting position. We got strong platforms in both hospitality and unattended retail, delivering high quality subscription incomes that are only going to grow. So we have a strong financial engine. Hospitality has turned the corner and is ready for growth, both in the UK and the USA. And in smart machines, we've got the real focus on footprint expansion in existing customers and the new ones that we just gained as part of the 3G, the switch off initiative that we had. And that in itself will drive the growth that we require from machines before we consider the additional income that we can expect to receive from the forecourt sector. Bottom line is that there is increased demand for data and insights as customers across all sectors look to do more with less. They got to be more productive because there's a limit to what they can do in terms of pricing and costs. So it's about being productive. Strategically, we're very well positioned. I've got the right products. We've got great people. Our finances are strong, and they're only going to sort of improve. We've focused really hard on being trusted advisors through COVID and post-COVID, doing the right thing and actually being honest with customers and driving the relationships and providing enterprise solutions. Bottom line is, whilst we're keen to deliver dashboards and alerts and traffic light systems to help people run improve businesses, we're also not averse to pumping the data directly into large enterprises so they can feed them into their own dashboards. And the market drivers are working in our favor and touched on those. So all in all, in a very exciting place and looking forward to the next months and years.
That's great, James. Mark, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James, Mark, as you can see, we have received a number of questions throughout today's presentation. And James, if I may now hand back to you to chair the Q&A, read out the questions where appropriate to do so, and I'll pick up from you at the end.
Okay, I'll read through the questions and we'll answer them as far as we can. Question 1, are you happy with the progress to date of VIANET Americas and comfortable with the level of investment up to now into BMI? Are you any closer to securing an Oxford partnership style contract in the States? I guess number 1, I'm very happy with the progress with Beverage Metrics. So what did we get? When we bought Beverage Metrics, we got some great people and we got some excellent technology, and those people are fully integrated into our business now. Their CTO is now our group CTO, and he's a rock star. So we're in great shape in that respect. A better place than we've ever been from a technology perspective, and we've got strong engagement with customers in the States to the extent of I spend a month, with helping the sales team in the States. There's a lot to go at. It keeps us busy. We'd love to be further down the road, but we're making good progress. Oxford partnership is pretty much unique in the UK in that, as you can imagine, we've got 10,000 pubs and bars more or less in the UK. That creates a lot of data, and that allows Oxford partnership to produce some fantastic insights. In the US, we don't yet have the volume of installations and data to utilize Oxford partnership in the USA. But working with fintech, we hope to accelerate what we do. Of course, the other great thing in the States is that we don't necessarily need to sell in the draft beer monitoring module. We can sell in the inventory module that allows us to remotely implement a solution without having to create an infrastructure on the ground to go out directly to every single pub and bar. Next question. Can you expand on the specific initiatives or trends that have driven growth in your markets? That's part A. Part B, how much embedded growth do you have within your existing client base? Okay, let's start with the first part of that question. Mark's just, can we stick on the question? Yeah. The drivers are pretty much the same. Whether you're in unattended retail with a large vending park, or you've got a forecourt operator with multiple self-serve machines on your forecourt, or whether you're a pub operator at the independent level all the way through to large pubco, you need to be able to do more with less, because there's less flexibility in terms of your ability to play with costs or pricing, and that's where we can help. And that drives the pricing that we provide on our products, because we price to ensure that our customers get a return on investment. How much embedded growth do you have within your existing client base? If we look at the smart machines in the UK, the unattended retail in the UK, excluding the forecourt sector where there's still substantial growth opportunity, take our existing customers, there's in excess of 20,000 machines for us to go at in terms of connectivity across their estates. So that in itself could deliver our growth in the next couple of years. Within hospitality, there's probably about another 1,000 pubs and bars within our existing customers that we could actually look to drive our solutions into. And that's before you start to look at the wider independent managed and hotels and sporting club markets that become a target for us with our fast scan inventory solution. Next question. The US operations can be potentially very positive. How do you see this opportunity playing out? How large is the opportunity? Who are you competing with, and what resources are needed? There's a number of questions there. I think I've touched on the scale of the market now, and there's probably an immediately addressable market of about 50,000 bars and chains that we will be sort of targeting. Our access to the market, through our relationship with fintech, clearly helps and gives us a unique opportunity. There are loads of different inventory solutions out there that are generally linked to point of sale systems. I think what's unique about ours is that very detailed recipe build up from the base. It's probably 3 years old, so it's been built using expertise that has been gained over a 3, 5, 6 year period by the beverage metrics team, and it's basically cutting edge. And who are we competing with? On the one, there's probably only about 5 players that do draft beer in the United States. Nobody here in the UK. There's probably about 50 people that do point of sale and inventory, and there's probably another 10, 15 do inventory only. But we're the only people who are doing the full end-to-end inventory and draft beer flow monitoring. So, and we're the only people with that relationship with fintech, so we're in good shape. Regarding the business model, are 100% of the vending machines sold rather than rented out? How much of the operating profit arises from sales? I'll hand you over to Sarah for this one.
Yeah, so the vending machines are actually 50-50, half are rented and half are CapEx models. So it depends what the customer wants, and they will be on contract from 3 to 5 years, dependent on which they choose. In terms of the operating profit, have you got that?
Yeah, I mean, the operating profits, it's a blend of the CapEx sales and the recurring revenue. So, as we said, we've got a recurring revenue of 74% in the year. That's down on the previous year. That's because there's been more hardware sales in the current year, but ultimately there's been the growth in sales and growth in recurring revenue.
And as you might expect, the subscription type revenues that we derive from the recurring long-term contracts, they are higher margin than the hardware. The bottom line is we don't have to give away the hardware to generate that to extend that footprint. But if we really had to, then we would, but we don't have to. We make a reasonable margin on hardware, and we should be able to sustain that. How much of the recurring revenue is for maintenance type activities, and how much is for analytics?
In a nutshell, the customer gets charged a blended fee, but predominantly most of it is for the data insight that we provide the customers. There's very little, if any, maintenance around on the unattended retail side. Any of the maintenance is more in the hospitality sector, but it is more driven by the data analytics than anything else.
Now we have a question from Colin. From Jeff. How do the recurring revenues for connected unattended machines compare with the other units? But I guess in unattended retail, we basically have the contactless payment solution, or we have a telemetry solution where there's no contactless payment required. And the contactless payment solution is probably 2.5-3 times the subscription price that you'd pay for telemetry. And obviously pubs and bars. Pubs are substantially larger than a vending machine, so it's not really comparable in that respect. How do the recurring revenues for connected unattended machines compare with the other units? I think we've just had that one. Yeah. The next question is from Colin. Is Smart Zones being renamed as Beverage Metrics? No, Smart Zones is not being renamed as Beverage Metrics at this moment in time. Smart Zones increasingly will be called our hospitality division, because it's all encompassing. It's about hospitality. It's not just about smart zones. What we have done is iDraft and Smart Draft will be increasingly known as Beverage Metrics. And within Beverage Metrics, you have an inventory module, you have a beer module, and we may have other modules in due course.
Perfect. That's great. James, Mark, Sarah, thank you for that. I believe you have addressed all those questions for investors today. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, James, could I please ask you for a few closing comments?
Yeah, just simply reiterate that we're in a really good place. The markets are moving in, market drivers work in our favor. Our products hit the mark in terms of pricing and the return on investment. And that return on investment that we give customers will continue to drive our footprint expansion, which will drive our subscription incomes and give us the earnings and cash generation that we want. So an exciting place to be. And thank you for joining us today.
Fantastic. James, Mark, Sarah, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of VIANET Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.